Welcome back to Insights Unlocked. I'm extremely excited to release this discussion with Jeff Snider, founder of Eurodollar University and one of the foremost experts on the global monetary system. He's widely known for his unique perspective on all aspects of its misunderstood inner workings and how they impact global markets and the economy. Jeff has been a huge influence to me in trying to understand the complex macro environment we've experienced over the past few years, and I'm grateful to have the opportunity to chat and dig into some of the questions that I know myself and all of you folks have been trying to piece together about the world we live in today. Let's jump right into it. All right, perfect. Thanks so much for joining me today, Jeff. Really appreciate you taking the time.
Thanks for having me, Jim. Pleasure to be here.
Yeah, I must say, before we get going, I've been a huge fan of the unique perspective you bring to really analyzing our global monetary system. And a lot of your work has pushed me into deep rabbit holes at times, trying to piece together all those various factors. And so we're excited to have you chat and dig into some of the answers to the questions that we have today. So let's start off with a bit of an overview of the state of the economy at the moment. And so, just for some context here, the US economy grew 2.6% in Q3, beating expectations, supported by strong exports, while consumer spending remains fairly steady, and we have a job market that is still relatively healthy. And so, there seems to be a divergence between economic growth and consumer health, as employment levels are still high, while consumer balance sheets are still relatively healthy with moderate amounts of leverage. And so, Jeff, what do you currently make of consumer health right now? And where do you foresee issues with the consumer emerging as we move into 2023?
Well, the state of consumers is in some ways perplexing, as you said, Jim. There's a lot of ambiguity about the state of the economy, starting with consumers. I mean, anecdotally, you hear any number of stories about how consumers are struggling, which you would expect given the price pressures and the basic necessities, gasoline, food, maybe rent, depending on how you calculate and depending on what you're talking about. But under those types of circumstances, you would expect that the consumer would be struggling. But as you say, it's not as if consumer spending has fallen off a cliff. On the contrary, in real terms, consumer spending is sort of iffy, sideways. It's not horrible. And I think that's really where the disconnect is the idea that, recession is coming. And so shouldn't consumer spending be leading the recession? Therefore, consumer spending should be absolutely atrocious. And that's really where the recession comes from. And I don't think that's ever the case. I think consumer spending ends up being a lagging indicator more than anything. And that's some of the other parts of the economy where the downturn really starts to hit. Then it gets into the labor market, and then the consumer spending really softens. And so that raises, what is the labor market doing? Because consumers have been survey after survey saying they're more concerned about prices than they are necessarily about jobs, although that's starting to rise too. And so you haven't really seen that major break in the labor market either, where companies are saying we need to fire thousands of workers, mass layoffs, the type of cost cutting measures that are usually associated with recession. We haven't seen that either. But that doesn't mean that we're not in a period of weakening or a transition from expansion to contraction. There are several concerning warning signs out there that suggest that the process is underway, even if you can't see it right now and see it very clearly right now and say, yes, this is a recession. This is what's happening. There's a number of processes that take place before recession. The real part of the real meat part of the recession happens that we can see all over the economy, starting with the labor market too. While firms are not necessarily laying off workers, they aren't necessarily hiring them either. You sort of go into that transition where companies become more careful about managing their payrolls and their workforce. They get very careful about managing their capital expenditures. So you have this softening transition between expansion and contraction, where it seems if you see that these things are happening, you're more concerned about where the economy is going. Whereas because it's sort of ambiguous from a high level perspective, it creates a lot of uncertainty, confusion about what the economy is actually doing.
Right, that makes a lot of sense, and I think, the other major part of that, as you touched on, is corporate health, right? And so Q3 GAAP earnings, as projected by the S&P are projected to come in around $47.2 per share, which is, still near the 2021 high of $49.5 a share a year ago. But, on the other hand, as you mentioned, guidance seems to be getting weaker and weaker. And also on the manufacturing side, we've seen October PMI print down to 50.4 and ISM at 50.2, which is the lowest since May 2020. And so, yeah, Jeff, what do you make of the health of the corporate landscape here moving into Q4 in 2023?
And that's usually what the leading part of any recession is that companies look at their not their past earnings, their future earnings potential, and that's where it all starts. And we're as you mentioned, Jim, companies are looking ahead and they're starting to scale back revenue as well as profit estimates. Profits maybe a little bit more so because obviously cost pressures are still exceedingly high, and they're going to remain high because it's not tied to the economy. Gasoline, energy prices in particular, food prices. That's non-economic. So companies have to factor in the fact that we're dealing with political fallout in their price and in their cost structures. And eventually, if you get a little bit weakening in revenue, it leads to all those self-reinforcing processes of a recession where companies say profits are going lower because revenues aren't going to stay up. Therefore, they got to make adjustments in cost where they can. You can't do anything about energy. So what can you do? Well, at first you stop hiring as many workers. Then maybe you start cutting hours. Then if it still doesn't go well, that's when you get into the layoffs and all the more recessionary processes. But that's really where we are in Q3 into Q4 is companies I think are now starting to make those judgments because earnings projections and revenue projections are starting to really soften up more than they already have. So it's sort of like the acceleration to the slowdown rather than the slowdown slowing down.
Right. Off the back of that, let's touch on inflation. And so US CPI is at 8%, and the Fed's favorite inflation metric, PCE, is up to 5.1% year over year, 0.1% lower than estimates, but still the highest since April. And so, Jeff, what's been driving inflation currently? And can you lay out your view of why, moving forward, inflation is indeed, dare I say it, transitory?
Use the word. Use the word. Be confident. Say it proudly. Now, it's transitory is a loaded word. It has become a loaded word because it sounds like temporary shouldn't be a year and a half. But any kind of macro scale, transitory can be a couple years. It doesn't necessarily mean 2, 3 months and it's over with. And I think that's really the problem. People lost patience with the idea that the forces at play in the supply part of the economy, global supply actually, the politics of it. Geez, I mean, those things are not going to work themselves out over a couple of days or a couple of weeks or a couple of months. In fact, we're still dealing with high energy prices. Why? Because various domestic policies, various global policies, oil producers want to cut back and keep oil prices high. When they should be adding production, simple economics, when prices go up, they should be adding more supply. They're cutting it back. They're cutting it back in response to weakening demand, too. So companies, transitory, all this, it's all the rest of the consumer price bucket where we start to see um, up until this point slowing price growth, not yet really falling prices. Um, a lot of retailers have said we've got way too much inventory, but up until this point, they've kind of managed their inventory by slowing the amount of inventory they're accumulating. We haven't really gotten into the massive discounting and liquidations. So moving forward, just like in the corporate sector, in the goods economy, outside of energy, food, and rents, because rents is it's a whole other ball of wax with owner's equivalent rent and everything else. The parts of the goods economy that is tied to the economics of the situation, you should start to see those prices begin to fall. Amazon just had its second Prime Day last month. Didn't really go all that well. Amazon's, massive amount of inventory. They need to clear it out. Everybody knows they need to clear it out. Christmas shopping season, which is the prime shopping season for all retailers. Every retailer's got massive loads of inventory, softening consumer spending. It's the recipe for not just discounts, but heavy discounted, even liquidation in inventory. So, generally speaking, The parts of the CPI that are tied to actual economic circumstances, we're not, as I said, up to now, they've been the rise in prices has been slowing. Would expect that those prices actually begin to decline in the months ahead, especially maybe into December and January, depending upon how soft the Christmas season actually goes. So there is a situation, there is a path to lower CPIs in those parts, or lower parts of the CPI, apart from energy, food, and rent.
Right, that makes sense. Economic data still coming in and printing relatively strong. We have a stable job market and CPI at 8%, at least in the Fed's perspective. There doesn't seem to be any reason to slow down rate hikes, at least not yet. But let's look a bit further into 2023. And so Eurodollar futures have been inverted for quite some time now, and the camel hump just seems to keep getting steeper with the shorter end whites moving up
I know,
higher
it's
again.
amazing.
Yeah, I know, right? Compared to last week at a peak of about 5.2%, I think, in which we then get, crazily heavy inversion into H1 of 2023, with the market essentially saying that the more the Fed hikes, the more cuts will then have to follow.
That's right. That's the crazy part, right, Jim? It's doesn't matter what the Fed does. Whatever happens. It leads to rate cuts.
Right.
It's doesn't it. The Fed is completely out of the equation, except for how far will they go and how far will they get.
Yeah, and so essentially, you do concur with the Eurodollar market's view, right? In terms of kind of magnitude and timing here, and what are your thoughts on the potential Fed pivot here moving into next year?
Yeah, you're right. The magnitude is the thing to focus on. Timing is always up in the air,
Okay.
and the timing has shifted back and forth throughout this year. The inversion started out way far in the back of the curve, as it always does, and it progressed all the way up to the December 2022 contract at one point in the middle part of the year. Then the market said, "Well, maybe the economy doesn't fall off as fast enough. Maybe the CPIs don't come down far enough." But that's really the question, right? The Eurodollar futures market, which you should never bet against. History says you don't bet against the Eurodollar futures curve because it's been right every single time. But what is the market actually saying? What the market is saying is as near a certainty as possible in a dynamic world. I mean, we can never be 100% certain about everything. Nobody has a crystal ball,
Right.
but something is going to happen in the relatively near future that causes the Federal Reserve to stop hiking rates and then start maybe aggressively cutting them. And that's, I mean, what would that be? There's only a narrow list of candidates here. And if we look at what's causing the Fed to hike rates, as you just said, Jim, it's pretty simple case. As long as the CPIs are high, the Fed says we're going to continue rates. In fact, we're going to continue hiking rates until we see the CPI not just go down, but we're reasonably assured it stays down. So there's basically two possibilities that get the Fed out of its rate hiking regime. One is that happens to the CPI, that we have what would have to be a pretty substantial contraction in a very short, condensed period of time where the CPI actually does fall and probably the unemployment rate rises precipitously. That would be one way for the Eurodollar futures curve scenario to play out. Another way would be something happens that gets the Fed to forget about the CPI regardless of where it is. So the CPI could still be at 8%. The PCE deflator could be at 6%, and the Fed says, "Oh crap, something else is going on." Now, what would that be? That would be something like a global financial crisis, right?
Right.
And we sort of got a taste of that at the end of last quarter. Most people don't pay attention to the deep internals, which is understandable. We had a collateral shortage, a collateral scarcity that turned into an absolute run at the end of Q3. Now, people probably noticed the symptoms of it, the UK, the gilt market, some things happening in Europe,
Right.
but they probably don't realize where that came from. So there's already a lot of warning signs that the monetary system globally is not operating in an ideal shape. It's actually operating in a near crisis shape because repo fails at the end of the Q3 were almost $1 trillion. Haven't seen that
Jeez.
in many, many years. It was almost double what it had been in March of 2020. So we had a real monetary break there at the end of September. That stuff in the UK was just a symptom of that. And if we have something worse than that, you could say maybe that's what brings the Fed out of its focus on the CPI and thinking we need to aid the monetary system because that's become the primary risk to the global marketplace and the global economy.
Yeah, yeah, that's really interesting, and we'll touch on the collateral shortage a bit more in a second. But one more question on inflation. I mean, like CPI fundamentally, it's really sort of an issue for the Fed to rely on, right? Because it's a lagging indicator, and it's just based on data in the past. And so in an ideal world with an ideal Fed, if you can even begin to imagine that, what metrics or indicators should the Fed be using to really judge whether or not to raise or lower interest rates?
Well, that's the thing. In an ideal world, which obviously does not exist and never could exist, but honestly, inflation is all about money supply. Is there too much money or is there not too much money? And the answer is
Right.
no, there is not. I mean, we just talked about some of the deflationary consequences of the monetary system. And what's driving the CPI isn't really inflation, it's supply shocks and politics and all these other things. So if we separate these issues down to is there or is there not too much money, that becomes a real, that's what the central bank should be focusing on, but that's not what the central banks do nowadays. They can't. They haven't done that in decades because they have no idea what's going on in the monetary system, which is why they're reliant on these economic aggregates like CPIs or the unemployment rate, which are at best lagging. And at most times, like the unemployment rate, they're misleading. So the Fed is relying on bad data because it doesn't have any other choice. It doesn't know what's going on in the monetary system. So, what other options does it have? But in an ideal world, they would say, yes, there's too much money. We need to cut back on the money supply. Boom, inflation's gone. Now they can't. The central bank can't do anything about oil prices. They can't get more oil out of the ground.
Right.
They can't get more shipping containers to China or untangle the railroads in Chicago. That's beyond the capabilities of a central bank. In an ideal world, we would never turn to the central bank to fix those problems. So those price pressures have nothing to do with money supply or the Fed or anything else. Those are all about non-economic variables. But what we can say is that look, this is not a monetary thing. This isn't over a production of money, which I know most people say, what are you talking about? The Fed QE, the federal government in 2020, all that stuff. But the monetary situation is far more complicated. It's beyond the capabilities of the Federal Reserve to define, let alone measure. So we don't have the ability to say, let's turn off the inflation, let's turn off the money, which is what really should happen.
Yeah, that makes sense. And so let's now dig a bit deeper into the Eurodollar system and the dollar shortage. And so this all presumably plays back into higher lending costs and lower expectations of growth, right? And so first, fundamentally, can you shed some light into how Eurodollar banks play a large role in credit creation and contraction? And what's really happening now in the shadow banking system that's creating and driving this global dollar shortage?
It's basically risk aversion, right? In a ledger virtual currency system, a reserveless currency system, it's all based on risk perceptions. In fact, that's how most banks operate, and they have investment banks anyway. That's how they've operated since day one. It's everything is about risk adjusted returns. So even if returns seem relatively good in the nominal economy, but risks are greater than the returns, banks are going to cut back. Unfortunately, in a monetary system and a virtual currency system, we need banks to produce money and credit, which this distinction between money and credit has blurred to the point where it's impossible to tell one from the other, especially when you consider things like currency swaps and derivatives and how they're used. It's impossible. So we're really on a credit creation or a credit money standard, which means banks need to expand their balance sheet, their risk taking behavior in order to supply enough money slash credit to the economy for it to be able to grow at or near its potential. Because that's really what money is. Money isn't wealth, it's a tool that allows a modern economy to operate most efficiently. And to operate most efficiently in a wide across a wide section of the planet, because we're talking about a reserve currency system here, which means the dollar doesn't just affect the United States; it affects everybody. And if there's lack of reserve currency, that's a problem for us. That's a problem for Europe. That's a problem, obviously, for China and Asia and everywhere in between. And without the money and credit to operate efficiently, the economy efficiently, trade breaks down, economic growth lingers. There's too many frictions, there's too many inefficiencies introduced, which creates this economic drag. And so it all comes back to risk perceptions of those creating the credit and the money. If banks are perceiving a high level, a high degree of risk, regardless of nominal returns, they're going to pull back. And when they pull back, that causes all sorts of deflationary consequences, including massive financial instability, because markets don't have sufficient resources to operate in the way that they're supposed to either. The margins for error, they get narrower and narrower and narrower. It causes all sorts of problems too. And then it becomes self-reinforcing, right? Because banks become risk averse, they cut back on their balance sheets, that deprives the economy of credit. Then the economy starts to go soft, and then the same banks say we need to become even more risk averse because the operating environment is even riskier than we thought. And so, without any way to really interrupt that process, it just becomes this self reinforcing, oftentimes disinflationary, if not deflationary, spiral.
Interesting. And so, Jeff, where does the huge rise in global dollar denominated debt play a role in all of this, right? So, let me know if I'm thinking about this correctly, but as interest rates rise on the massive amount of global dollar denominated debt which needs to be serviced, is that then driving the increase in folks looking for dollars, largely for the unproductive purposes of servicing debt, which then takes away dollars from, the processes that actually contribute to economic growth? Is that a large reason of what's driving the dollar so high right now, and expectations of economic growth lower as well?
Yeah, it's all about, again, it's risk perception. So the rising dollar is nothing more than the Eurodollar system charging a premium. And it's really a
Okay.
liquidity premium to participate in the dollar system, which, because it's the reserve currency, and contrary to what many people say, there is no other alternative on the horizon anywhere that's going to challenge what the Eurodollar does as the actual reserve currency. The cost of operating in this monetary system have gone way up because there's fewer dollars out there. And there's, another misconception is that dollar denominated debt has somehow surged. It has skyrocketed since 2008, and that's just not the case. In fact, it's the opposite. We had dollar denominated debt skyrocket up until 2008, and then since then it has increased, but it has grown at a remarkably lower rate, which is in the nonlinear world that we live in, a massive contraction. So we have a lot of dollar denominated debt, but that's not because it's because of risk taking or because of too much money printing. There's a lot of dollar denominated debt because we operate on a dollar system and a dollar
Right.
standard. But you're right, there is an issue here with higher rates as well as a surcharge, a liquidity surcharge being charged by these dealer banks, that's causing enormous problems because participating in the Eurodollar system is more expensive, it's more inefficient, it's more troubling because of the circumstances that we find ourselves in. And it's not necessarily a matter of the Federal Reserve so much as it is the operation of the system itself.
Interesting. And so we've also seen some other cracks begin to emerge more recently with the use of the Fed's dollar swap line with the Swiss National Bank, where we saw increasing auction volumes up to 11 billion, as well as number of counterparties participating up until last week, where the use of the swap line dropped back to zero. But as a whole, $11 billion use of the facility seems like rather just a drop in the bucket, right? And so, what are the dynamics there? And does the recent halt in counterparties emerging for dollars mean that dollar funding is more stable for the time being? What else are you looking at that may suggest that the dollar shortage may be indeed getting worse?
Yeah, Switzerland's an interesting development, and I think it's, people look at it as sort of a black and white flip of a switch, right? If there's somebody there at the Swiss National Bank, it means things are bad, and there's nobody there the next week, $0 being bid, everything's fine again, and it's far more nuanced than that. Why there was bids at the Swiss National Bank, we'll never know because we're never privy to that sort of situation, but we can offer a couple reasonable guess, and I always go back to collateral. One of the primary problems in the collateral system is Italian bonds.
Okay.
Italian bonds, and because it's Italian bonds because Germany doesn't borrow enough money. The German bonds are the best of the best euro-denominated collateral, and the German government doesn't issue a lot of bonds because it doesn't have a large fiscal deficit.
Right.
Whereas Italy, as the third largest economy, has an enormous fiscal deficit and issues tons of bonds. So as far as the euro-denominated collateral goes, most repo in Europe is dominated by Italian bonds, which poses a problem for these various intermittent periods like 2018 or 2011 and 2022 when the market grows a substantial distaste for Italian fiscal factors and fiscal operations. So we've seen Italian spreads over Germans actually blow out this year. And it's not just euro denominated repo or euro denominated borrowing where that's a problem, because a lot of these Italian government bonds are swapped into US treasuries for borrowing in US dollars because Europe needs dollars too. Everybody needs dollars.
Right.
So if there are counterparties out there who have been swapping Italian bonds and the market spreads on the Italian bonds start to go higher, maybe they're not able to do that. So where do you go with your Italian bond? If you have a Swiss subsidiary, maybe you bid at the Swiss National Bank for dollars because you can't swap them into treasuries at the same rate you could before. Now, I'm just speculating. I think it's a reasonable speculation. So, but in the context of what we're talking about, the Swiss National Bank borrowing, there shouldn't be anybody there. There should be nobody borrowing at the Swiss National Bank at any time. So the fact that somebody was borrowing even $11 billion may not sound like a lot in the grand, like you said, Jim, in the grand scheme of things, it isn't, but it should be zero. And it should also be noted that there are times in history, recent history, such as May 2010, where we had a little bit of a spike in borrowing at the dollar swap auctions in Europe. Never got more than 9 billion, but that wasn't a nothing. That was a precursor. It was a presage of much bigger problems to follow, because it suggested that there was enough going wrong that some banks felt the need to go and at least, well, banks don't directly go to these auctions, but they get other banks that borrow on their behalf and then relend it to them. So if there are banks in the marketplace who are figuring they can profit enough by relending to more troubled banks, that means there are more troubled banks out there. So the fact that there's any lending at all or any borrowing at all at the Swiss National Bank or ECB or wherever it happens to be is a sign that there's a little bit to be concerned about here. But as you said, Jim, as you were implying, it's not really just about these dollar swaps. That's sort of a sideshow. That's sort of a down the road or down the line indication. The real stuff is what we see in the marketplace. And there's any number of warning signs that say things are not good. And it's not just Italian bond spreads over Germany, which I mean, again, these are they've decompressed tremendously. We've seen massive blowout in spreads there, which
Yeah.
can trigger all sorts of collateral prices or collateral problems. There's CLO issues, spreads, credit spreads on risky junk bonds, which again, collateral. Um, One of the primary indications of the collateral shortage that we've seen throughout this year is that T-bill prices go through the roof. Um, GC repo rates, maybe counterintuitively, when GC repo rates fall and fall below certain thresholds, that's actually a warning sign that things are not good too. We've seen all these things happen. We saw all those things happen in the second half of September. Any number, we can go on with interest rate swaps. Obviously, the US dollar's exchange value. And as I said, repo fails at an enormous high. All of it together combined, not the Swiss bank auctions, but all the market indications are telling you that there's something really going on here. Something is not right in the global monetary system.
Yeah, it's very interesting. Yeah, as you mentioned, the collateral shortage. Let's touch on that a bit. And so, as you mentioned, we have seen the 4-week T-bill trading extremely high, below RRP and SOFR in some cases, which is signaling elevated demand for pristine collateral, which is mainly based around USTs, right? And so, why is there currently a collateral shortage? Is it mainly due to QE and central banks buying up all those bonds over the years, as well as a tightening macro environment where lenders are demanding a higher quality collateral than before? Am I thinking about that correctly, or how do the dynamics currently look in the collateral world?
Yeah, there's a couple different factors, and you've got a couple of them there, right, Jim? Is that number one is QE can take collateral out of the system and then lock it up. The Fed does operate a securities lending program, but nobody really uses it because it's not really efficient. There's other
Okay.
factors and frictions involved with it too. But by and large, when the Fed buys bonds, US Treasuries from the market, that's removing collateral. Now, the Fed has learned from its own past mistakes in 2013 in particular, where the Fed is careful not to buy the best of the best collateral. They don't buy the on the run stuff. Now, they did that in 2013 and it came back to haunt them. And they haven't been buying treasury bills like they made a huge mistake in doing in their not QE5 in 2019 into 2020. They bought up to 300 billion in treasury bills at the worst possible time into March 2020. They learned from that mistake too. They haven't been buying, they've been reinvesting maturities in treasury bills, but they haven't bought any more bills. So the Fed is careful with QE not to buy the best of the best stuff, the liquid stuff, the on the run stuff.
Okay.
But regardless, they are still buying bonds and taking them out of the marketplace. The other issue in terms of supply and availability is the Treasury Department. The Treasury Department is issuing fewer bills because the Treasury Department doesn't consider bills or notes or bonds as collateral and money. They only consider what the Treasury Department is supposed to consider, which is the fiscal situation and the borrowing capacity of the federal government. So, because the fiscal deficit has declined, there's been less of a need for the government to issue bills in particular, and so they've been removing bills from circulation, even though the price of these bills, as you mentioned, Jim, have gone through the roof. In fact, the Treasury Department knows there's high demand for bills. They just converted one of their cash management bills into a regular now for a benchmark 4-month Treasury bill, regular auction Treasury bill, because there is this high demand for Treasury bills. They never say why, but they just, hey, there's high demand for Treasury bills. But regardless, the Treasury Department is responding to lower fiscal deficits by issuing fewer bills and fewer notes and bonds. So there's less supply. There's the QE factor, but the biggest factor in my mind is what you were alluding to there, which is the fact that there is always lower quality collateral in the system being used. And we also have to keep in mind that even the good quality collateral is reused and relent and repurposed and
Right.
rehypothecated in some circumstances. So there's a collateral multiplier on top of this consideration of junk collateral. And so, in situations like we've been talking about, where dealer banks in the system become risk averse, that's one of the things that gets affected. As you were mentioning, the junk or the lower quality collateral. Suddenly, we revalue that. We raise the haircuts on the lower quality collateral because repo counterparties want to protect themselves in case they have to sell the asset in case of default. So that causes problems, as does a lower multiplier, less of a reuse rate. So if treasuries are not circulating through the collateralized system as much or as fast as they normally would, that causes a problem too, where there's enormous collateral shortage because counterparties in the marketplace are not getting enough collateral that they need to run their portfolios. And if you don't have the collateral, you can't borrow, you can't assume leverage, and it leads to all sorts of negative consequences, including the worst cases, which are fire sales of assets, will just contribute to the self-reinforcing deflationary downward spiral. So collateral is absolutely vital to how the system works, and there are any number of ways in which it could be breaking down. And I would imagine, Jim, that it's probably all of them. You got the Treasury supplying fewer bills. You've got the QE that's locked up a lot of bonds, and QT doesn't actually help because it's not actually putting bonds back in the marketplace.
Right.
And then on top of it, you've got risk averse dealers who are probably scaling back their securities lending programs, which means fewer relending and reusing of good quality collateral. At the same time, they're rejecting and revaluing the lower quality stuff. And it's just a recipe for a mess.
Interesting. The collateral shortage largely then plays back into the dollar shortage, right? Because essentially what you're saying is that it's harder then to obtain dollars for a large portion of the market due to the fact that they can't access that collateral in order to then obtain more of that dollar denominated credit.
Yeah, and it's collateral isn't just repo, it's also in derivatives too.
Okay.
So if you're in a currency swap and the counterparty who you're swapping into dollars says, I think I'm a little bit risk averse here. I need a higher premium to give you the dollars in the swap. Well, there's two ways you can mitigate that. It's either put up more collateral or pay more in your local currency. And
Okay.
so the dollar goes up against the currency goes down, or you need more collateral. Either way, it works out to the same thing. And usually it's both at the same time. I need more collateral and I'm going to charge you more on the swap. So it's the dollar goes up and I need more collateral. That's really it's impossible to break that cycle. Really, it's Once
Right.
dealers become risk averse, then it leads to negative consequences, which makes dealers even more risk averse. But like the word transitory, it doesn't happen overnight. It doesn't happen all at once. It's a little bit here, a little bit there, and it spills over and it goes through time. Even the 2008 crisis wasn't in 2008. It began in 2006. It took 3 years from top to bottom, right? So even though we talk about these things and it sounds like we're talking about, oh my God, the market's going to crash tomorrow, that's not really what we're saying. Is we're seeing all of these processes play out and continue to play out, and they get a little bit bigger each time. The deflationary wave gets bigger, then it contracts a little bit. There's a little bit of a sigh of relief. Then you got risk aversion again, collateral chains collapse, and it produces the next wave, which gets a little bit bigger still. And then there's a sigh of relief and a little bit of risk taking, but then everything falls apart again. It's a back and forth fluctuation, a process which, if it doesn't stop, if it's not interrupted, that's where it leads into all of those nasty consequences, which happen to be, bringing this back to our earlier discussion, are priced into Eurodollar futures and the Treasury curve. There is something out there that the Eurodollar curve and the Treasury curve and even the German Bund curve, that one
Right.
that one inverted for the first time ever between the 10-year and 30-year long German bonds. Never had inverted before in the 2-decade history of the 30-year bond. Not
Wow.
only did it invert, it has stayed inverted. It has been in and out over the last month and a half. So we've got curves all over the world saying something is bothering the marketplace so much that it's picturing this upside down curve, which suggests for the Fed as well as the ECB and other central banks, they are going to stop hiking rates and are going to do something. They're going to start cutting them because something is going on here.
Right. Very intriguing. Yeah, as you mentioned before, we recently also saw, the gilt markets run into trouble, largely due to a collateral crunch, leading the BOE to help backstop and ease the gilt markets. Is that a potential solution that we'll need to see more central bank backstops in order to kind of ease that global collateral shortage moving forward? Or are there any other, potential solutions for this issue? Or does it normally just always lead to some type of global economic destruction?
Well, central banks are going to want to do something because they can't just sit idly by and pretend, that nothing's happening.
Right.
So the Bank of England is going to do. I mean, look, it sees the price of UK government bonds go down, regardless of why. They can't just sit there and do nothing. So central banks are going to respond to those types of events. Even in Europe, we already saw that happen in the summer with the Italian bond problem. The ECB came up with what it called an anti-fragmentation policy, which is, you just shake your head and laugh, which is basically, hey, there's too much of a spread on Italian bonds, and we're going to try to narrow that spread. We're going to buy more Italian bonds and sell German bonds to see if that works. And of course, it didn't, because it doesn't actually solve any of the problem. Just like the UK government or the BOE operation didn't solve the problem. Um, the marketplace, the monetary system is the real issue here. And if, in the terms of UK gilts, what happened was, in any sort of collateralized agreement, if I'm lending you dollars and you're giving me some form of security, even if it's a collateral for a collateral swap, where if I'm lending you treasuries and you're giving me UK gilts, should you default and not give me back the treasuries tomorrow, I have the right to seize and sell your UK gilts.
Right.
But if I perceive the gilt market is illiquid, I'm going to demand more of a premium to do the same collateral for collateral swap. So if for whatever reason the market becomes risk averse about UK gilts, that's what you're going to see happen. You're going to see the prices on those change to more align with perceptions of risk and operation in the marketplace. And there's any number of reasons why that the UK, like the Italian bonds, are being increasingly rejected by the marketplace. I mean, the UK is an unstable fiscal situation, which is, the tax cut proposal, which may
Yeah.
make sense in an economic basis, but didn't make sense in terms of the UK gilt market. But for whatever reasons, the dollar system, the dealer system, remember this is a bank driven system, didn't like Italian bonds, didn't like UK bonds, and so what are central banks going to do about it? They're going to have to try to do something, but that doesn't mean it's going to be successful.
Right. Are there any parallels or precedent that we can draw here in terms of the dollar and collateral shortage, and our current situation from historical cycles at all?
Yeah, I mean, we've seen this happen repeatedly, actually, ever since the first one. Which, if you were to distill the 2007 2008 crisis into a single factor, it was obviously a complex situation. But if you were to say one thing that really drove the 2008 crisis, it would be a collateral shortage. And so we've never really solved that problem ever since then, and we go into these intermittent cycles where we get a little bit relaxation, where the collateral, junk collateral becomes accepted. The collateral system expands a little bit but never really enough, and then dealers say, "Oh, we made a huge mistake here." Whether it was, Southern European, Italian, and Southern European sovereign bonds in 2010 and 2011, that created a collateral collapse into 2011 into 2012 that nearly triggered a crisis that was as bad as 2008. Came very close
Okay.
there. There was another one in 2014 and 2015, focused more on emerging market debt, junk bonds tied to oil prices, that kind of thing. That happened in 2015 and 2016. Another one in 2018, Eurobonds, and of course March of 2020. So we go through these intermittent collateral scarcity shortages, but this one seems a little bit different. This one seems a little more severe than any of those other ones, apart from, say, 2008 had been. And there's a couple of reasons why that could be, though. Again, because we don't have information, we don't have the ability to directly observe what's going on on these dealer balance sheets, in their
Right.
securities lending practices. We can't say for certain what's actually wrong here. Nobody can. Even the dealers that are operating in it, they look at it in a very small, very tunnel vision type of way. There's no real way for us to say this is the problem here. We sort of have to look at what markets are doing. We have to look at how the various prices are responding, curves, shapes, all of those things are changing over time, to try to get a sense of what must be happening from starting from a position of lack of information.
Gotcha. Super interesting. And so, lastly, I wanted to touch on the yield curve. And so, the 2 year, 10 year is pretty heavily inverted to levels not seen since 2000. And more recently, we've also seen the 3 month 10 year begin its inversion as well. And so, Jeff, first of all, why is the yield curve so heavily inverted? And secondly, you've spoken about the importance of the 3 month 10 year inversion, so why is the 3 months so important as well?
Well, like you said, Jim, it's progression. We start out with a little tiny bit of a inversion that's down the curve. Eurodollar futures, when it first inverted, that was last December, and it
Right.
was way out in the June 20 or the December 2025 contracts. And then the inversion slowly creeps up toward the front, getting not just getting broader as well as deeper. So the inversion, there's a progression here. And as it gets closer and closer to the front, that's when, number one, the market is more and more certain that something's going to happen. And number two, that something that's going to happen, while we can't say exactly when, we know it must be getting closer and closer. So as the inversion moves from back to front, that's the curve saying it's going to happen, and it's going to happen probably sooner. Same thing in the Treasury market and the Treasury curve. It starts with a little inversion that began between the 7 year and 10 year part of the part of the curve way back in March. And then it got moved up a little bit. They had the two tens inversion that it inverted for a little bit, and then it went away. And then the curve goes in and out of inversion. And then we got to June, when we had another massive wave of deflationary money. And then the curve, as you said, massively inverted between the 2 year and 10 year. And then ever since then, it's sort of been creeping slowly up closer and closer to the front. There's this progression in the yield curve inversion that tells us that the market is becoming more and more certain that something is happening, and more certain that something is happening sooner rather than later. Again, sooner is a term of art, like transitory. It doesn't
Right.
mean tomorrow, and it may not mean next month. It just means that in some, more likely the short run rather than the intermediate or longer run. And the 3 month 10 year spread is a key one, because it suggests we're getting into the very front of the curve, um, where policymakers suggest it doesn't really become important until it becomes the 3 month and the 18-month forward rate, or the 2 year, if you really want to look at it very simply. Which is, again, it's what we're all saying is that there's a progression here. Policymakers say you ignore the yield curve until it progresses to the very front, And now that we have the 3-month bill inverted to the 10-year, we're almost to the very front. So in terms of trying to figure out where we are in that progression, that's a key warning sign, a key signpost that the market is again more and more certain that something is going to happen that's going to lead to lower rates in the near future. That's really what the inversions suggest. And it's up to us to kind of fill in the blanks about what that would be. But given the Fed's stance on CPI, as we mentioned, and the economic and financial reality, especially the monetary reality, the list of suspects that are going to cause lower rates in the near term future is pretty small at this point.
Have we seen the 10-year yield peak here? And do, probabilities and scenarios suggest that the yield curve could invert further, or are we kind of peaking out here?
Every time that it looks like the longer end of the yield curve is peaked, it gets pushed up by another rate hike at the short end or whatever. So I
Right.
don't. That is the wild card here. Not the something that's going to happen or lower rates. Those things seem to be baked into the cake. It's the wild card is when does the Fed finally realize this something is happening, and when does the Fed finally incorporate that something into its policy process? And that's it's impossible to tell because again, like CPIs, you're not dealing with economic factors, you're dealing with human factors, you're dealing with politics.
Right.
The Fed isn't operating on a basis of, like I said before, an ideal central bank. It's a political bureaucratic institution who looks at its job very differently than what it should. And so they're saying is, hey, the CPI stays high, we're going to focus on the CPI to the exclusion of everything else. And what the market is saying is that's a big mistake, and that at some point this something else is just going to make it impossible to focus on the CPI. But then you're judging when will Jay Powell finally turn around and look at this something else, and that's impossible to say. And so there's definitely some upside potential in interest rates. I mean, the curve is just probably going to get more and more inverted as the short-term rates go higher, as we've seen in all the rest of the curves. But that doesn't mean that the long-term rates can't go higher, because they've been going higher all year, pressured by what the Fed is going to do rather than by what the economy is going to do, because the economy is doing something else. And so it's really just a game of trying to figure out when does the Fed wake up? When does the Fed wake up and stop focusing on the CPI and start focusing on reality, forward-looking reality? And that's, who knows? And until the Fed actually decides and says, maybe it's today, maybe the Fed comes out today and says, you know what, this is the last 75 basis point rate hike because we're getting phone calls from all over the world. The Reserve Bank of India said, hey, we're spending tons of our reserves because there's a dollar shortage, so knock it off. The Chinese, the Japanese are spending hundreds of billions of their reserves. So maybe that's happening and we don't even know it. But that just goes to my point where it's impossible to tell when the Fed will say, when will the Fed cry uncle? Don't really know. We just know that there's a high probability that happens at some point.
Right. Staying on the long end here, from a fundamental supply and demand perspective, as we know, the three of the largest holders, China, Japan, and the Fed, have continuously sold off the long end. So, I mean, who's the marginal buyer here of treasuries moving forward? And are China and Japan selling treasuries in order to obtain that additional dollar liquidity for their own economies?
Yeah, the second part of that question is exactly right.
Okay.
The reason foreign governments sell treasuries, central banks and reserve managers sell treasuries, because they're trying to supply dollars into the local system that they're not getting from the marketplace.
Right.
And not necessarily supply, sometimes it's just subsidizing.
Okay.
Eurodollar borrowing becomes more expensive, so the central bank steps in and tries to subsidize local Eurodollar borrowing, usually as a temporary measure, believing that it's a short-term disruption in the market. And so we sell some treasuries, subsidize local borrowing, everything goes back to normal, and it's all fine again. That's not usually what happens. China is a perfect example. I mean, they spent $1 trillion in the reserves back in 2014, 15, and 16 to no avail, by the way. So central banks try to meet their dollar needs by selling reserves as a last resort kind of measure. Now, as far as who's buying treasuries, there's any number of people. This is the part that mystifies everybody, because it doesn't seem like anybody should be buying treasuries. But a couple of things that we've seen recently this year. Number one, foreign private entities, probably financial institutions, have been buying record amounts of U.S. treasuries, not just bills, but long-term treasuries. That's where
Okay.
they've been buying. In fact, they're probably thanking Jay Powell for cheapening them, allowing them to buy them very, very cheaply. So one reason why the yield curve is so inverted because people outside the United States can't get enough of these long-term treasuries because they see the consequences of the US dollar system more directly than we do here in America, where we're sort of sheltered from the rising dollar and what it's doing to the rest of the world. So they're buying US Treasuries, safety, liquidity, US dollar denominated instruments, as are many basis traders, hedge funds. One of the things, we heard this too many treasuries argument back in 2018 when the Tax Cut and Jobs Act of 2017 was passed that raised the deficit. And everybody said, oh my God, who's going to buy all these treasuries? The Fed's doing QT. Foreign governments seem to be selling their treasuries. There'll be no way to service all of this debt. Yet what happened? Treasury yields went lower. Treasury prices went high. There was absolutely no problem absorbing that debt because hedge funds took advantage of a quirk in the marketplace that happened to incentivize leverage trading in the safest liquid US dollar denominated assets. They took about, I think it was 2 trillion in treasuries. So they were actually buying what foreign governments were selling. As
Interesting.
crazy as that sounds. And the basis trade has come back this year too. So when people say they're concerned about who's going to buy treasuries, as long as there's an incentive in the marketplace to do so, meaning a fundamental proposition of demand for liquidity, demand for safety in the US dollar denomination, there will always be a place for treasuries. And that's not even getting into the collateral considerations where there's demand for collateral, the best of the best quality collateral, which really, when that happens, like we see in T-bills, it really propels demand for these instruments. So as far as demand for treasuries go, there's plenty of demand out there, even if you can't put it into a single bucket like foreign governments or the Fed or pension funds or whatever it happens to be.
Right, yeah, that's interesting because I was thinking, like, due to the collateral shortage, like, there must be a lot of private parties that would scoop up tons of treasuries if you were gonna offer it to them, right?
And they do. They buy them. They buy them at almost any cost, and that's really
Right.
the thing here is that. And then once that happens, it becomes a self reinforcing process too, because as the price of collateral goes up, everybody realizes I got to have the best quality. I saw people start buying at any price, which is why you
Right.
saw in late 2018, for example, during that period, Treasury yields fell precipitously because of the collateral squeeze at the end of 2018. So regardless of all year, we heard about too many treasuries, and then all of a sudden there was this huge demand or huge spike in prices for those instruments because of collateral considerations, primary among everything else.
Yeah, it's super interesting. And so lastly here, um, we're going to see a pretty large influx of treasury issuance coming into the market in November at least with 234 billion net new treasuries. And so I'm also curious, where does the overnight reverse repo facility play into all of this, right? Like, there's still about $2 trillion sitting in the overnight RP. Does this start getting drained as treasury issuance increases, or what's that $2 trillion going to do?
Yeah, and that's the reverse repo is something that's also very much misunderstood. People talk about it as there's too much money, all that stuff. But as
Right,
we've seen, bank reserves have been falling this year, and the reverse repo has been pretty much steady. It's because there's not enough collateralized opportunity for the amount of cash out there. It's a measure of risk aversion. If you have excess cash, like a money market fund, for example, you only want to lend in very safe short term instruments. Your options are either treasury bills or repo. And if you go into the repo market and there are not enough counterparties giving you the collateral that you want, which is usually treasuries, you don't have any other options. You have to go to the Fed because the
right.
Fed is the only other option that can offer you the same type of alternative, which is what the reverse repo window is designed to be. It's designed to be an alternative. It wasn't designed to be an alternative for a collateral shortage. It was designed to be for what everybody says to soak up excess reserves. But that's not what we've seen this year in particular. We've seen risk aversion among money market participants where they're only going to the Fed because there must not be enough counterparties in repo that have the right collateral, which is why, as I mentioned before, GC repo rates, therefore SOFR rates, have come way down.
Right.
It's not because there's too much money, it's because there's not enough good quality collateral that cash can find a counterparty using that collateral. So if we have more treasury issuance, that may help a little bit. Not, I'm not too optimistic about it. It might help a little bit with more introducing more collateral into the system, which could take a little bit out of RRP, could firm up repo rates and so forth and things like that. But to me, it's always about the risk aversion part and the dealer multiplier, the collateral multiplier. If we could have a greater supply of collateral, but a small contraction in the multiplier that not just offsets it, but completely cancels it out. So if dealers become even more risk averse in the fourth quarter, it won't matter that there's more collateral. And as I said, Jim, I'm not worried about more treasury issuance, especially if they're issuing more bills. That's a positive thing for the marketplace, not a negative.
Very interesting. Well, thanks so much for your time today, Jeff. Really appreciate it. We have a lot for investors to digest as we move into Q4 in 2023. And so, where can the folks find more of your work?
They can find me at Eurodollar University, which is my YouTube channel is Eurodollar University, and the website is eurodollar.university. Lots of stuff there, information. We talk about this stuff all the time. Deep dives into the monetary system, and more so the consequences and implications of all of these things, which are, as you're saying, maybe we're living in very interesting times, which is both it's a curse as well as a as a benefit for people who are interested in really finding out and digging into these things.
Yeah, highly recommend you all go check that out. Well, thanks so much for your time today, Jeff. Really appreciate it.
My pleasure, Jim. Thanks for having me.
Take care.
All right, take care.